Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Blackwell is ramping very fast. 11 billion sales in the quarter. That's well above our expectations. That's well above what the company guided for last quarter of like several billions. And I think that's what the street likes in the print. It means that Hopper revenues are declining overall sequentially. But the most important takeaway here is that it dismisses concerns of a slow, of a backloaded year.
Well, of course, we're running a deferred revenue model, and so it takes a while for the revenue to build up. And also, the level of scale that we're delivering, Brian, is incredible. We're not a small company. We're now, as you can see, there's only Microsoft and Oracle have ever delivered revenue above 40 billion. So we're in rarefied air. So it will take a while then for Data Cloud and Agentforce to get up there.
The first 6, maybe 9 months of the year will probably end up being in a trading range, and it has been year to date a trading range. But then you'll have a sharp fallback, and particularly your late third, early fourth quarter, typical almost seasonal weakness in the stock market. So it could be just a very wobbly year with a pullback in the market that would benefit defensives because they would hold their value.
1 hour to go until the market close, and we're taking a look at the major averages that are now selling off all across the board. We did get some comments from President Trump sort of reiterating his stance on tariffs and also talking about an additional 10% tariff on China on top of the 10% that had already been put in place. All of that equaling stocks now falling, the Dow off by more than 100 points at the moment. The S&P 500, which was also negative, going further into the red, down 1%, and the Nasdaq down by nearly 2% at this point.
Yeah, there is tough tariff talk. So Trump is saying, okay, those tariffs we talked about on Mexico, Canada, those are proceeding as planned. And then you mentioned this additional 10% levy on China. It's interesting, Joy, because we've talked to a lot of investors on the show and strategists. And granted, they don't work in Washington or inside the Beltway, so they're taking their best guess. We've had many of them kind of emphasize this theme of, well, I think it's a giant negotiating tool at the end of the day, right? Yes. And I guess that was sort of the take, and maybe that's the optimistic take.
Well, and that's the take, until you get another headline, which sends things down, and then they come back up again as people think maybe that's the take. So that's kind of the back and forth, the seesaw we've been seeing. But then underlying that, you also have earnings that continue to come in, and we just heard from Salesforce's Mark Benioff there. Investors aren't buying. The stock is down today. If I see it somewhere on this board, I'll point it out, but we know it is lower after the numbers. And then you got Nvidia, of course, and Nvidia shares just keep trending lower and lower today, even after its numbers on the whole looked pretty decent, except maybe with the exception of some of the gross margin forecast. But really the numbers were not that huge of a problem. But maybe if China is going to be more of an issue, that could be a problem.
I think that's part of it. It was interesting because you kind of read through the analyst commentary today of the folks who were actually paid to give you a recommendation on the stock. It was broadly positive, Julie. I mean, it was, results were solid, demand is strong, guidance was fine, right? It was not, though, the kind of blowout quarter that maybe a lot of folks had gotten used to, and that could be playing a role as well.
Yeah, perhaps so. I mean, keep in mind, the last couple of times Nvidia came out with earnings, the stock did not perform. And then also wanted to look at the sector action here. We've got energy stocks that are still doing well. Oil prices have been higher today. You got tech deeply in the red now. Utilities in the red being pulled down by numbers from First Energy and Vistra. So those are the two groups that are really creating the big drag today.
Some economic data, too, worth pointing. Jobless claims jumped above consensus. Pending home sales worse than estimated. All right, President Donald Trump speaking about more tariffs that will be coming during a press conference today. Take a listen to that.
10% tariffs has already been implemented on China. Are you planning to do an
additional 10 above the 10?
This will be an additional 10 above.
It's 10 plus 10. In
10
case,
plus 10
was there confusion on that?
There was, sir, yeah.
Okay, 10 plus 10, it's a second 10.
For more, we're bringing in now Yahoo Finance's senior columnist, Rick Newman. 10 plus 10, Rick. Makes sense of it for us.
20, as many of us would say.
I'm trying to figure if it's compounded or not. I mean, Trump probably hasn't thought this through. He needs to ask his Treasury Secretary, I guess. I think Trump means it. I think he is going to impose another 10% tariff on Chinese imports. As you try to, I mean, it's hard to keep track of all the tariffs Trump has threatened, and then which has he actually imposed so far, and then which ones does he actually mean? I think he means the ones on China, because that fulfills kind of a long-term goal he has. I mean, he wants to basically kind of decouple the U.S. and Chinese economies. I think the other ones that would be very problematic for the U.S. economy are the tariffs on Mexican and Canadian imports, 25% each. I think that would be too damaging. So I think Trump is threatening those, because he's trying to get some concession. But Goldman Sachs this week put out a note saying we think markets are underpricing tariff risks because they're being too cavalier about this idea that this is just to get leverage and then they're not going to happen. So we're going to get more of these. I mean, the question, I don't know how many, to what extent we're going to get tariffs, but we're going to get more.
I wonder, what is the overarching goal? In all seriousness, I mean, is it revenue raiser, domestic manufacturing? Is it national security? Does it check all those boxes?
It's not one goal, it's several goals, and this is different from what Trump did during his first presidential term. So what he said then was he mostly focused on the trade deficit, the overall trade deficit with the rest of the world, but also country by country. I mean, he used to say the goal of the China tariffs in 2018 was to lower the U.S. trade deficit with China. He's not really saying that anymore. So among the explanations he has given, help build up domestic industries. I mean, that's just not likely to happen. In some cases, he wants something specific from each country. He wants help stopping inbound migration from Canada and Mexico, even though there really is hardly any inbound migration at this point. Fentanyl, he wants help from these countries with illegal fentanyl shipments. If there's any kind of like positive takeaway, he is structuring these demands in a way that it's easy for him to say, okay, I got what I want at any point in time, because these metrics are fuzzy. He's not saying I want fentanyl shipments audited to decline by 50%. He's just saying I want less fentanyl coming in. So at some point he can turn this around. And we know he's sensitive to markets. So if there's any check on his tariff ambitions, it is markets.
Although it's unclear if we keep saying we know he's sensitive to markets. Is that still the case, though? He hasn't tweeted about it, right? Or truthed about it. I don't know what the verb is there. He hasn't posted about that, really, about how the markets have been doing, even when the markets.
Well, he hasn't had anything to brag about, has he?
No, but it was a little over a week ago that stocks were at a record high.
Yeah.
So he didn't talk about it then. So the thing that we're all taking for granted, that he still cares about markets, I don't know if we should take that for granted.
I don't know that we should either, but here's a clue. We have had the Treasury Secretary, Scott Bessent, saying, we are paying attention to the 10-year Treasury. Right. I mean, that is the most reassuring thing for investors that anybody in the Trump administration has heard so far, because they want the 10-year going lower, and that in order for that to happen, we have to know that inflation is under control.
Or we have to be worried about growth.
So that's the other side. It could go down.
For it to be going down.
So if it's going down for the wrong reason, which is that the economy's tanking, that's a whole other problem.
Yes.
Thank you, Rick.
Got it?
Thank you. Appreciate it, my friend. For more on the impacts of tariffs on the markets, let's now welcome in Rob Hayworth, U.S. Bank Wealth Management Senior Investment Strategist. Rob, it is good to see you. So we were just talking there, Rob, to our colleague Rick Newman about tariffs. President Trump talking very tough there. These tariffs on Mexico and China, Rob. He's saying they're going to proceed as planned. An additional 10% levy on China, Rob. I'm curious, as an investor, as a strategist, you hear all this, Rob. How do you try and make sense of it?
Well, I would say we're following kind of Austin Goolsby's mantra, which is a little bit of wait and see, and how does this impact the data? We were very close to 20+% tariffs on Mexico and China a month ago, and they were delayed at the last minute. I think that's some of what the market is looking at as we think about a range-bound market here, where we're evaluating what are we going to get. If we get them, I think the challenge for us is what does that actually do to economic data? And I know we've had a couple of concerning data points over the last couple of weeks. One would be January retail sales, but that seems explainable by one-off effects. Two would be today's initial jobless claims report, but it is a weekly number. It tends to be highly volatile. That could be a one-off as well. So we're waiting to see if there's a trend that we are damaging consumption in this economy. That has been the primary driver of economic growth if we think about the last year and a half. And that's what we're looking for as we move forward. So tomorrow's personal income data, PCE data will be important. And then the jobs report a week from tomorrow will also be really important. What is the consumer really experiencing? Are they still employed? Can they still spend money? Or are they starting to pull back because of all this uncertainty? And certainly what we've heard from earnings season so far is companies are not clear on the full year of 2025.
They're not clear, and they're worried about tariffs too, Rob. Bloomberg crunched the numbers on the mentions on conference calls of tariffs, and they're at a new record. Something like 700 times they've come up during these quarterly earnings calls. So, you know, it's not just consumers who are paying attention to these headlines. It's obviously companies that are too. So again, I understand the wait and see aspect of all this, but 10% tariffs on China, additional tariffs on China are already in place. 10% then on top of that, it seems, are set to be going into place. And that Canada-Mexico deadline, it's around the corner. So, you know, I understand also the impulse to wait for it to show up in the data, but I mean, everybody's talking about it at the very least.
Yeah, we can't wait too long. And certainly you're seeing some, some technical challenges for the S&P 500 today. I think we'll pay attention to that. For now, we'd still say, you know, it's a glass half full economy, right? We have 4% unemployment. Even at 242,000 last week, that's a very low jobless claims number when we look at history. And consumers have been fourth quarter GDP growth was still 2.3%. So we still have a fairly constructive background, and we don't want to miss kind of the next level for the market. I think that the challenge and the risk is one, at what we're seeing today kind of from some of the tech stocks is valuation and any potential hit to growth. But there's other areas of the market that are actually inexpensive and maybe benefit from the Treasury Secretary's preferred lower 10-year Treasury yield. Thinking of income-oriented names, real estate, healthcare, right? There's probably some room for rotation in this market as we look out over the next 6 months. And it's worth thinking about your overall portfolio position and maybe not be too concentrated in those top 8 names and start looking into other sectors of this economy.
Rob, you mentioned earnings. I did want to get your take just on Nvidia. We were waiting on pins and needles, Rob, for that report, right? It was going to be the most important report of the earnings season. We were all going to hang on, every word of CEO Jensen Huang on the call. And clearly investors seem disappointed today, Rob, in that report. I'm just curious, that report, the reaction, the response to it, are there broader lessons for the market as a whole, Rob, that you take from that?
Well, I think the challenging thing about this earnings season, and we've seen it in the economic data too, is it's been kind of in line as expected, nothing exciting, right? Nothing to tell us things are going horribly, but nothing for us to get tremendously excited about at this point either, which is kind of why we're seeing this range-bound market. And I think that's what we're hearing from NVIDIA. They delivered, right? They delivered on expectations. They slightly improved on forward views. And we've heard that from many companies so far. No one's been tremendously missing. Not no one, but right on average, right, we're coming in line with where we expected, and we're not getting a lot of forward guidance. And I think that's really the challenge for the market is with that lack of clarity, we're waiting for a driver or something to give us direction. And that's leading us back to the Fed, maybe tariffs, but we're not sure how much and how long. And then economic data.
So as you wait, right, you said you're looking to some of those areas of the market, like healthcare, for example. Healthcare that trade's gotten a little more crowded this year, right? It's actually the best performing S&P 500 group this year so far. So kind of what characteristics, I guess, are you looking for, either within healthcare or more broadly in the market, that you're looking to ride this period out with?
Yeah, we think it's companies that are sensitive to interest rates in a kind of constructive way. So as we get interest rates staying lower, right, the Fed's bias is eventually, maybe someday, to cut rates again in 2025. we think those are the sectors that start to do better. We've seen decent performance from real estate. We could see decent performance from utilities, particularly as they start to incorporate some of the past price increases into their earnings moving forward. And then healthcare really broadly rather than narrowly for us, because this is a sector that's been really challenged, and things probably are not as bad as we've seen prices take the hit over the last couple of years, and things could get much better there.
What about technology and communication services, Rob? Would you stick with those sectors?
We think you have to be there in the long run, right? There's some real risk here at the top. For us, that's a long run hold. We think it's constructive over time, but certainly as we're seeing today, right, there is some near-term challenges, and these are already very heavy weights in portfolios. So rebalancing remains an important thing for investors to think through how much. You're already kind of over allocated in those spaces. It's worth looking to other elements of the economy that could see benefits as we press ahead, not just technology.
Rob, thanks so much. Good to see you.
Thank you. Very good to see you.
Kansas City Fed President Jeff Schmid speaking earlier today, giving his thoughts about the path for inflation. He had a unique approach amongst Fed members. Yahoo Finance's Jennifer Schonberger has the details for us. Hi, Jen.
Good afternoon, Julie. Kansas City Fed President Jeffrey Schmid says he's growing more cautious that inflation can continue to drop as consumer expectations for inflation have surged. In a speech this morning in Arlington, Virginia, Schmid said, quote, "Now is not the time to let down our guard. It could be argued that some of the factors driving up inflation expectations are likely one-off transitory developments. But again, given recent experience, I'm not willing to take any chances." Schmid's concerns come after a survey from the Conference Board showed consumer confidence dropped sharply this month as inflation expectations for the year ahead jumped to 6% from 5.2% amid higher egg prices and concerns about tariffs from the new Trump administration. Schmid said that while the risks to inflation appear to be to the upside, discussions with contacts in his district, as well as some recent data that suggests that uncertainty might weigh on growth. Indeed, if you take a look at a chart of the 10-year Treasury, the yield appears to reflect that sentiment. The yield today as low as 4.26% on the session, having steadily dropped since hitting nearly 4.8% in mid-January. Schmid following many other Fed officials in recent weeks to take a wait-and-see approach, though the threat uncertainty poses for growth is one Schmid says the Fed will have to balance with upside risks to inflation, and we will get a fresh reading on the Fed's preferred inflation gauge tomorrow. Back to you.
Can't wait. Jen, thank you. We're just getting started here on Market Domination. Coming up, Synopsys reporting a beat on its latest earnings results. We'll hear from the company's president and CEO on the other side to discuss those results. Stick around, much more Market Domination still to come.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Synopsys delivering a beat on earnings and reiterating its full-year guidance, including expectations for double-digit revenue growth. The company noting it continues to see strong design activity fueled by the AI-driven reinvention of compute. For more on the quarter and what's ahead for the company, we've got Synopsys CEO and President Sassine Ghazi. Sassine, it is good to see you as always here, and it's especially interesting to talk to you on a day, of course, Nvidia, one of your big customers, reported last night. Those shares are down. And it doesn't seem like there is uneasiness about the AI thesis, but maybe just about sort of the growth trajectory and what's priced into the stock. So I'd actually would start there, how you're sort of thinking about where we are in the cycle and what investors should be expecting from here.
Hi, Julie. Great to be here. Like any disruptive technology, and AI is absolutely one of the mega trends that will drive a completely different change in many end market applications workflows. It started with big investments in data centers and infrastructure build-out. Now what we're seeing is that early adoption of AI applications at the endpoints, be it your PC, your mobile device, etc. And DeepSeek actually was one of the great proof points that as you make it cheaper, more reliable, more affordable, you get adoptions at the application level. And that drives silicon proliferation everywhere because you need silicon both at the training and data center and silicon at the end device level, which is a great opportunity for Synopsys.
Sassine, on the conference call, I want to come here to a line you said. You're talking about your end markets, Sassine. You said from an end market perspective, AI and HPC remained robust in the first quarter. Then you said, Sassine, while industrial, automotive, and consumer electronics remained challenged. So I guess if I was an investor, Sassine, I'd want to know, where is the bottom there? Do you have line of sight?
Yes, on AI, HPC, very strong silicon design activities with actually a pace that is shrinking, meaning the roadmap is being accelerated from 18 months to 1 year delivery on these products. For consumer electronics, mobile and PC, in the last 2 quarters, we saw a pickup on new silicon design activities to bring AI to these devices. And you see it happening with number of customers and number of applications. The place where we have not seen customers bringing new roadmap items is in automotive and industrial, which is expected to happen toward the end of 2025.
I want to ask you about China as well, because I know you're experiencing some headwinds there, like many in the industry, and there's uncertainty about whether further export controls will be put into place, right? We just heard President Trump today talking about another 10% tariffs on top of the 10% tariffs that have already been imposed, and we could get retaliatory tariffs. So how are you planning out for all of those possibilities?
So China for Synopsys, if you look back 5 years ago, was growing well above the corporate average. In Q4 23, we started communicating that is going to decelerate to around corporate average, which happened in 2024. What we communicated actually yesterday as we are reaffirming the guidance for the year is these headwinds are going to continue and the deceleration will continue to below corporate average due to 2 factors. The first factor are the restrictions. The cumulative effect of these restrictions are slowing down the chip activities, especially for the high-end chips in China. And the second one is the macro and the economy inside China remains challenging. And when you bring these 2 factors in, that's the cautious that we provided around China.
Sassine, do you think that these export controls are the right policy for the U.S.? You know, obviously they're disadvantaging companies like yours and many more, and you still had the development of something like DeepSeek. Do you think these policies are misguided?
We work with the U.S. government, actually with the Biden administration, now with the Trump administration, to promote a resilient supply chain for the exact reasons that you just mentioned. The restrictions are having an impact where it is slowing down an organic development inside China. But if you zoom out to the macro, like the DeepSeek example you mentioned, it really demonstrates the ingenuity of engineering. When you over-constrain a problem, you try to find a different way to optimize. And what they've done, they optimize at the software level, distilling the model from a training in order to get to an end application. So there's always a way to look at the overall optimization chain and find an opportunity to optimize.
Sassine, is this deal for Ansys, are you still confident it's going to get done in the first half? First half, Sassine, June is going to be here before we know it. I mean, how confident are you the Chinese are going to really approve this deal? I was talking to an analyst today, Sassine, he covers your stock, covers the name, and he argues this is an overhang on the stock.
It is an overhang on the stock, but we continue to anticipate a closure in the first half of 25. And really for two reasons. China will be no different than other jurisdictions, that this is one, a pro-competitive deal, and two, significant support by customers. And as you see how we have navigated through the approval process with FTC, CMA, EC is based on these two components and theses, and we don't believe it will be different or should be different with SAMR in China.
Sassine, it's really good to see you. Thanks so much for joining us.
Good to see you too.
Now time for some of today's trending tickers, starting with IonQ. Those shares down double digits today after the company reported fourth quarter earnings that included a loss per share of 93 cents. That's far worse than what the street was estimating. The quantum computing firm did report a revenue beat, however, but it looks like that, that investors were kind of viewing it, analysts at least, kind of viewed it as a mixed report.
Yeah, and I mean, stock down today, but pull back that chart. I mean, it's been a huge move for at a 125% over the past 12 months. Some changes in the C-suite too. CEO change. They named Niccolo De Masi as the CEO. Analysts do broadly like this name, even after this run. Needham is one of them, has a buy in it. Told their clients, solidifying itself, they say, Julie, as the 800-pound gorilla. Right. In quantum networking.
I mean, something to point out here when we're talking about any of these quantum computing companies. I mean, the company for the full year is looking for revenue of at most $95 million. They are not large yet, right? This is still very early stage. And so it's not that the earnings are irrelevant, but this is mostly just a bet on the future of quantum computing sort of more broadly.
Vision.
Exactly.
Yes.
On the vision.
Our next trending ticker, let's check out C3 AI, the enterprise AI company delivering a Q3 beat on both earnings and revenue, but it's down today after reported revenue growth below the gains it posted in the previous quarter. So AI software company posted results. Obviously, folks seem a bit underwhelmed here. Analysts at Bloomberg, by the way, saying report signals little movement and share gain from growing enterprise AI investment or its multi-solutions foray, while its recent partnerships with hyperscalers, though a step in the right direction, they say, likely leaves the pace of revenue uplift unclear.
Yeah, and because the pace of revenue uplift is unclear, the pace of when they're going to turn profitable is unclear, according to Morgan Stanley. They're asking about the timeline for operating profitability, for them to tick into profitability, and for positive free cash flow as well, and sort of drawing that into question because the revenue growth is sort of decelerating to some extent.
Yeah, Oppenheimer, they have an outperform on this one. Again, they mentioned the strategic partnerships they mentioned companies like Microsoft. They say positions this one for accelerating growth, though it does look like they did lower estimates on the company.
Yeah. And then we got Mara Holdings, our next trending ticker, the company formerly known as Marathon Digital, getting a boost today after the crypto mining company reported record high revenues and net income for the fourth quarter and the full year. The company also revealed it reduced its energy costs significantly by deploying its first owned power generating assets, and it said it was exploring opportunities in artificial intelligence. Who among us is not doing that.
Right. Total revenue for the fourth quarter, that beat came in around 214.4 million. Needham has a hold on this one. They say potential revenue diversification positively as the Bitcoin backdrop is becoming more uncertain. It's been rough though. Look at this chart. It's down now about 55% over the past 12 months.
Well, they trade a lot with Bitcoin, and they are among the companies that have Bitcoin on the balance sheet. So that's something
you're saying can get volatile
as well. Can be.
Yeah.
Yes.
All right, coming up, we're going to hear from the Port of Long Beach CEO on the other side to break down what the impact of Trump's tariffs could mean for ports. Stick around, much more market domination still to come.
The Port of Long Beach just had its best January ever, and it was also the second busiest month in its 113-year history. But with President Trump's promise of tariffs looming, officials are preparing for a new world when it comes to cargo volume and labor demand. Joining us now, Mario Cordero, Port of Long Beach CEO. And Mario, to be clear here, you guys had this amazing month, but that's because people are trying to get ahead of the tariffs, correct?
Well, there's a component of that people are front-loading imports to get ahead of the tariffs. But on the other hand, it also is reflective of the economy that we have here in the U.S. We have a very good economy thus far, and consumer spending in the holiday season from November to December. I mean, those numbers increased beyond the expectations that some economists had previously.
So Mario, President Trump talking tough on tariffs. He loves tariffs, Mario. We know that. I have a couple questions for you on that. If they are ratcheted up, Mario, how does that impact you all? How does that impact import volumes? And two, Mario, if they're ratcheted up, who bears the cost of that? Is it the shippers, Mario, or is it Mario and Josh?
Well, thank you for the question. As to the first part of the question, I can answer that just by looking at the previous impact when we first encumbered the tariff issue, and I'm talking the first Trump administration. So if you look at the initial tariff implementation back in 2018, the Port of Long Beach, when you look at our 2019 volume as compared year to year to the previous year, as a result of that tariff policy then that continues, we lost about 20.5% of imports coming from China. So that was the impact then. And of course, now it remains to be seen what that impact will be moving forward.
Well, what kind of indicators are you getting, right? Because the 10% additional tariff on China has gone into effect. There might be another 10% on top of it, according to what the president talked about today. So have you started to see any kind of change in flows?
Well, we have not started to see any change. Obviously, we commenced the commentary this morning or this afternoon with the record year that we had in 2024, and that's furthered by our numbers that we've had in January. So far, again, we're having record numbers. But on the other hand, there's also concern that you're seeing, whether it's from the Conference Board, the University of Michigan Consumer Confidence Survey, and of course, economists across the board with regard to potentially what that impact may be.
Most of the stuff coming into your port, Mario, it's coming from where? Would that be China?
Primarily, our imports are from China. So if we go back to the 2019 experience, as I mentioned, we had a 20% reduction in imports from China back in 2019 as a result of that first implementation of tariffs. On the other hand, we did have a 10% increase from other regions, from Southeast Asia specifically, countries like Vietnam.
I also noticed there was a headline about a proposal. It hasn't been approved yet, but a proposal from the U.S. Trade Representative that would charge a fee on Chinese ships who are coming into U.S. ports, whether it be Long Beach or any of the other ports around the country. The fee could be up to $1.5 million per ship. If that went into effect, what would that do to your business? What would that do to prices of goods that were coming in on those ships?
Well, first of all, that would impact all U.S. ports that have imports coming into the country. And by that, I mean every major international carrier either has vessels that are built in China or has vessels that are built in China as part of their fleet. So one way or the other, it is going to have an impact with regard to the fees that will be now accompanied with a vessel call to any port in the country, be it Long Beach or the Gulf or East Coast ports.
Have you all, Mario, been talking to the Trump administration?
We haven't had any specific conversation, although I do know that our industry advocacy groups apparently have had that concern. And again, those concerns are being expressed. On the other hand, I will say that if in fact some of this tariff discussion is being put forward in the aim to negotiate other aspects that the White House believes are legitimate to address, then again, I think we have to have a wait and see scenario. So at this point, I think if we have a conversation 6 months from now, we'll be in a better position to assess what those impacts are.
Mario, great to have you on the show today. Thanks so much for your time. Appreciate it.
Thank you so much for the invitation.
Earlier today, President Trump announced that his proposed tariffs on Mexico and Canada will go into effect on March 4th and clarified his plans for additional tariffs against China. Take a look.
10% tariffs has already been implemented on China. Are you
No,
planning
that's
to
an
do
additional 10 above the
This
10.
will be an additional 10 above.
It's 10 plus 10. In
10 plus
case,
10
was
is
there
fine.
confusion on that?
There was, sir, yeah.
Okay, 10 plus 10, it's a second 10.
The president has made tariffs a core piece of his second-term agenda, touting them as a revenue source and wielding them as a threat against other countries. Joining us now to discuss all this is Edward Fishman, senior research scholar, Center of Global Energy Policy at Columbia University, and author of Choke Points, American Power in the Age of Economic Warfare. Ed, great to see you here, and congrats on the book.
Thanks so much. I'm so happy to be here today.
So you're actually the perfect guy to talk to today. Well, listen, President Trump talking tough on tariffs. He likes tariffs. He likes sanctions, Ed. Tariffs as a policy tool, I'm curious, as you look throughout history, traditionally, typically, how effective are they?
So tariffs throughout history have really been used more as an economic tool, either to raise revenue, as you mentioned before, sometimes to protect industries domestically from foreign competition. The thing that's a little different about how President Trump is proposing to use tariffs, he's trying to use them as a tool of economic warfare to pressure the Canadians and Mexicans to stop the flow of fentanyl across the US border, to pressure China from stopping to send fentanyl to the United States. So he's really using tariffs as kind of another form of sanction, as something that he could use to get America what it wants.
So given that that's not traditionally how they've been used, what can we extrapolate from history about how effective they might be?
Look, tariffs, generally speaking, if you're using them as a tool of economic warfare, are a very weak tool. So you think about what is a tariff? A tariff is a tax on imports. So even if Trump does put a 25% tariff on Canada, US companies will still be able to import things from Canada. They'll just pay a 25% tax. That's why tariffs, generally speaking, are not good for US companies. By contrast, sanctions block everything, right? So if you impose a sanction, for instance, on a country like Iran, we can't import anything from Iran, right? It's a much more aggressive instrument.
Well, and it's seen as a much more. I mean, if it's dramatic enough that the president is threatening these tariffs against our allies. But if he was to say, "I'm going to put sanctions on Canada," I mean, maybe that would be a line he couldn't cross. I don't know.
I mean, it's not something I would recommend.
Right.
I think tariffs on Canada and Mexico are also not a particularly wise policy. And we'll see if they actually happen. I think when President Trump was gearing up to do this in early February, Monday opened, the markets were not very happy about the prospect of 25% tariffs on our two biggest trading partners, and Trump backtracked. So my strong suspicion is I don't think these tariffs are going to go into effect next week, at least on Canada and Mexico. Will we see an additional 10% tariff on China? May well. And that's actually a big point of what I talk about in Choke Points, which talks about how Trump developed his China policy. And this has been a consistent theme: tariffs on China, export controls on Chinese tech companies like Huawei. But we haven't yet seen anything like that against Canada and Mexico.
And the title of your book, Edward, is Choke Points. What are choke points as governments define them?
So historically, choke points have been geographic features, like the Bosphorus, which connects the Black Sea to the Mediterranean. And historically, the only way to really block a choke point was to literally take a Navy ship and park it right in front of it, right? And that's a big part of how warfare happened all the way up through the beginning of the 21st century. What's happened is, in the wake of hyperglobalization, with deeply integrated financial markets and supply chains, now a US official can just sign a document in his or her office in Washington and block these choke points across the world. And so what we're using now aren't so much these geographic choke points, they're economic choke points, like the US dollar, like advanced computer chip technology, and like energy supply chains, in which the US has a dominant position and there are very few substitutes.
And so how is this remake? We've talked a lot about the remaking of the global order over the past, call it decade, right? Where you're not as much seeing this coming together of global economies, but more of a re-separation of those global economies. What then is the outcome of all of these leaning on these choke points?
This is the narrative that I talk about in my book, Choke Points. Globalization is dead, and we are now living in an age of economic warfare. Sanctions, tariffs, export controls, they are the primary way that big powers like the United States, like China, like Russia compete with one another. And this has been a trend now starting in 2005, 2006, that's just grown exponentially and is going to continue to grow exponentially during Trump's term. So I think where we're headed is really one of two futures. One, where we have still tight financial and economic linkages, but only with other allies, only with other democracies. And where there's another bloc that's led by China, very similar to what it looked like during the Cold War with the sort of West and the Soviet Union. But there's another future, and this is the one I'm actually more worried about. And I think it's where, if Trump were to go ahead with tariffs on Canada and Mexico, it's where it would take us. And that's a more chaotic breakdown of the global economy, in which every nation is sort of for themselves, and companies in the US can't feel confident about long-term investments unless they're in the United States. And where the reason that's bad is not only will it be bad for the United States economically, inflation, slower economic growth, but history shows that when states can't acquire markets and resources through open trade, they're tempted into things like imperialism and conquest and war.
I'm curious, you mentioned a number of choke points that government officials can potentially have at their disposal. Is there one choke point that you would say that typically is the most impactful one?
The US dollar is by far the most important choke point. If you look at it, 90%.
That seems pretty good for the US.
It is. It's why we're the most powerful country in economic warfare. 90% of all foreign exchange transactions include the dollar. So if you're doing trade internationally, you're using the dollar. The thing is, though, there are choke points come and go, and some of the most important emerging choke points are actually under China's control. A key one is critical minerals. And I think if you're looking at the deal that Trump is trying to strike with Volodymyr Zelensky when he's coming to the White House tomorrow, a lot of that is to try to reduce China's ability to weaponize this choke point against the United States.
So I guess my question would be, we know that President Trump views these negotiations as having a winner and a loser, right? We know that from historically how he has operated. With the U.S. still having that powerful U.S. dollar as the most important choke point, will the U.S. win?
Look, I think so far what Trump has been threatening has been tariffs. Tariffs are not weaponizing the dollar as a choke point. They're weaponizing the American consumer, right? The fact that we're a big importer, right? Because remember, tariffs are a tax on imports. Were Trump to go ahead and threaten financial sanctions against Chinese banks, that would be a much more significant threat to be putting on China than tariffs.
Eddie, thank you so much. Really interesting stuff.
Yeah, my pleasure. Great to be here today.
Coming in. Well, the Personal Consumption Expenditures, or PCE price index, it's a measure of inflation that tracks how much prices change for goods and services. Kenny Polcari, host of the Yahoo Finance podcast Trader Talk, takes a deeper dive at what the index measures and how it can be viewed as more important than the consumer price index.
What is the PCE index? The Personal Consumption Expenditures Index is a measure of inflation that tracks changes in the prices of goods and services purchased by U.S. households. It is released monthly by the Bureau of Economic Analysis and is considered a more comprehensive and accurate reflection of inflation versus the Consumer Price Index, or the CPI. The PCE is derived from consumer spending data and includes adjustment for shifts in buying behavior, making it a more dynamic measure of inflation. It is often compared to the CPI, but the Fed prefers PCE for monetary policy decisions. What does the PCE index measure? Well, it measures price changes in goods, so think food, clothing, cars, electronics, services, healthcare, rent, education, financial services, durable goods, appliances, and like I said, automobiles, non-durable goods, gasoline, and grocery products. Headline PCE includes all categories, including food and energy. Core PCE excludes food and energy, which are typically more volatile, and, like I said, is the Fed's preferred measure of underlying inflation. Why is this important? Well, because it is their primary gauge. It is the Fed's primary gauge. The Fed uses core PCE, not the CPI, when making interest rate decisions, and that's important. The Fed targets 2% inflation year over year based on the core PCE. Today, the core PCE is plus 2.8%, so we're close but not there yet. If PCE inflation is high, the Fed is more likely to raise interest rates because that would suggest a hot economy, so they'd raise it to cool the economy. If PCE inflation is low, that may suggest the economy is struggling, so they would cut rates to stimulate growth. It is more accurate than the CPI. The PCE is considered more reliable than the CPI because it captures a broader range of goods and services. So, for instance, healthcare spending paid by employers. Right? It accounts for consumer substitutions. So, for instance, if steak prices rise, people may buy chicken instead. It's less volatile than the CPI, providing a smoother trend line for policymakers to consider. The bottom line? Why should investors watch the PCE? Because it determines the Fed's policy. The Fed bases rate hikes or cuts on the core PCE trends. It moves markets. A hotter PCE reading can cause stocks to sell off, while a cooler PCE reading can spark a rally in stocks. It reveals economic strength or weakness. Rising PCE suggests strong demand, while a falling PCE may suggest consumer slowing spending. Here's the final thought. If you're trying to predict the Fed moves and understand interest rates, then watching core PCE is non-negotiable. It's the inflation number that actually matters.
Wall Street still digesting yesterday's earnings report from Nvidia. One segment that stood out was the company's automotive business. For more, we're bringing in Yahoo Finance senior autos reporter Pras Subramanian. I mean, we talk all about the data center business, right, Pras? That gets a lot of attention. But the auto segment is growing quickly.
Yeah, we talk about that juggernaut Blackwell chip business, but under the radar here is that auto business, up 27% from the prior quarter and up over 100% year over year. NVIDIA's CFO said the bills will grow from 1.7 billion to 5 billion this year. So it's not nothing, but basically the way it works is that when it comes to self-driving, there's tons of data that's collected. It needs to be analyzed. This is where AI comes in and NVIDIA's chips powering it. Jensen Huang said Jensen Huang and others believe there'll be millions upon millions of self-driving cars out there and tech out there. I believe that is true as well. It's called physical AI or embodied AI. It's autonomous cars, even robots, harnessing the power of AI to move freely in the real world. That's sort of the big bet here on NVIDIA with cars in particular.
And I want to ask you also about cars moving around in the world without drivers, right? There's a report today that Tesla is exploring doing some trial runs in California of its cyber taxi. This according to the Washington Post. This may be not a surprise because we knew that they're going to be testing this, but what do we know so far?
It seems the Washington Post got a hold of Tesla's application for a permit to test these cars, and basically it'll allow users to summon Tesla vehicles for free for now on robotaxi trips. The permit states that Tesla will own and operate the vehicles and that employees are there to observe, so they'll be in the cars when the cars are being deployed. This is in contrast to Texas, where the company will test paid unsupervised robotaxi drives, similar to what you see with Waymo in different cities in the States. This is huge for Tesla, right? So it's the big bet on its valuation hinges on the success of robotaxis and fully autonomous vehicles. Same could be said a little bit for NVIDIA and its auto business too, but one thing is for sure, we have a long way to go before this is actually reality for many of us here.
Pras, great to see you. Thank you.
Thanks, man.
While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for market domination overtime.
Welcome to Yahoo Finance Sports Report, a unique look at sports business brought to you by Yahoo Finance and Yahoo Sports. I'm your host, Joe Pompliano, and I'll be breaking down the financial side of the game for your financial gain. We'll go beyond the headlines, analyzing all the latest sports news, the teams, the trades, and billion-dollar deals, so you and your portfolio will win big. Catch Yahoo Finance Sports Report on Thursdays on all your favorite podcasts and streaming platforms.
There's the closing bell on Wall Street, and now it's market domination overtime. Let's start with the major averages here because we definitely saw selling into the close once again here. Markets not holding on to gains. So the Dow ending the day lower by about 193 points, 0.4%. The S&P 500 down 1.6%. And so now looking at this 5-day slide that amounts to more than 4%. The Nasdaq doing the worst of the three major averages. Look at that slide over the past 5 days, 7%. And on this single session, nearly 3% as we saw the slide into the close. Now, the leg downward that happened late in the day seemed to be catalyzed by some comments from President Trump that there could be an additional 10% in tariffs on China. That's on top of the 10% that went into effect earlier in the month. He also reiterated this morning that those 25% tariffs are going to go into effect next week on Canada and Mexico. A lot of market participants have sort of shrugged off that those tariffs are going to go into effect. So whether this is real concern that they're going to go into an effect or just sort of a momentum downward and broad growth concerns kind of remains to be seen here. If you look at the groups that are doing the worst in the S&P 500 on the day, you've got tech really dragging down the other sectors, down by 3.6%. Utilities also taking it on the chin, in part because of some negative earnings within there. And within tech, of course, we got to look at what happened with Nvidia shares really picking up steam to the downside as the day went on. Even though, as Josh and I discussed earlier, analysts broadly thought the results were pretty good here. Maybe it's just that they are not beating by the same magnitude that they had been in recent quarters. But this is the worst reaction to earnings going back at least a year for Nvidia with that 8.5% slide. If you look at the selling, it was pretty spread out. Apple down, Amazon down, Microsoft, Alphabet, and Meta. Broadcom also down quite a bit with Nvidia. These concerns, not just about China tariffs, but that there would be an increase in Chinese export controls that would hurt profitability of these companies. Also a concern. Tesla continuing its sell-off as well. Those shares down 3% on the day. And we have been tracking the Tesla selling that's been happening. The stock peaked back on December 17th. Since then, down by 40%. Even, coming back pretty much the levels where it was right after the election. So a lot of selling today continuing, Josh.
All right, Julie. Tariff concerns spook in markets today, plus concerns about the health of the economy also weighing on investors. And the recent decline in consumer confidence could mean more bad news. According to our next guest, joining us now is Mark Malik, Siebert CIO. Mark, always good to see you.
Thank you. Good to
So,
be here.
so let's talk. Julie was just mentioning tariffs. President Trump likes tariffs, Mark. He's a fan of tariffs. He was talking tough today, saying, listen, those tariffs on Canada and Mexico, they're gonna proceed as planned. He mentioned this additional 10% levy on China. I'm just curious how, as an investor, strategist, you try to think through that. We've had other investors come on, Mark, and sort of suggest they almost kind of look through it. In other words, it's tough talk. It's a lot of huffing and puffing, but I guess they kind of see it as just one giant negotiating tool. Is that how you see it?
Well, it's how we try to see it, but it's becoming increasingly difficult. And it's not necessarily the tariffs themselves as much as the disinformation around the tariffs, the unknowns about whether they're actually going to go into effect, how much they're going to be, if they're going to last. And I think that information, that sort of fog of unknowns, it just is overshadowing just about everything. It's very difficult even for the well-trained investor to look past this and say, hey, when is pen going to be put to paper? What do these look like? It would almost be good, even if they're large, if we knew what they were going to be, then we could start to factor them into our models. But at this stage, we don't know what's going to be and what's not going to be, and that's really got everybody a little bit on edge, and it's basically applying some weight to the whole market at this point.
I mean, it's hard for companies too, right? We were looking at some Bloomberg data that was tallying up the number of mentions of tariffs on conference calls. It's at a record. It's around 700. Yeah. It spiked the last time there was all this talk, but it's spiked even more now. And how much does that have the capacity to weigh on decision making at companies and therefore weigh on earnings potentially going forward?
Oh, it sure does. I saw that same graph earlier, and those numbers are rivaling 2018 numbers, and we definitely saw companies having impact, making decisions based on what might happen. That's the job of management to anticipate these types of things. I think the challenge is again, if we knew what they were, if the companies knew what they were, because now we're talking about a VAT tax and a VAT tax versus a tariff, and I think at the end of the day, it's all kind of negative, but how negative and where that impacts the companies and their decisions, knowing more would help. And I think knowing very little at this point is getting more challenging.
So it's uncertainty for the company and the CEO market. It's also another uncertainty for the consumer, of course. We got a consumer confidence report this week. We had another strategist on the show. I think he used the word stinker. Is how he put it. What do you think as a strategist? You see these sentiment surveys coming out.
Yeah, this consumer confidence is the ultimate leading indicator of how the economy is going to perform, right? Because consumers have to consume in order to grow the economy, and consumption is 2/3 of the economy. And so if consumers are not confident, if they're afraid of what their jobs are going to be like, or if they're afraid that they're going to have no control over costs and things like that, they're going to consume less, plain and simple. I mean, if you look at the consumer confidence number going back many, many years, you could see that it clearly decreases before major recessions. So seeing that number is a little bit of an eye-opener. We saw it in the Michigan number earlier in the month, and it really, stinker is a good word for it. Mm-hmm. It was a stinker, and I think if people ignore it, they do it at their own peril at this point.
So what do you do as an investor? I mean, you've just been talking about the challenge of there's so much indecision. So as you try and wait to figure out what's going to show, and this seems to be a theme that's emerging. We're talking to a lot of investors who are saying, it's really hard right now.
Yeah.
Where do you position yourself in the meantime?
It's very challenging. We believe, from a long-term perspective, we're still very, very bullish. I think there's a lot of very positive signals coming from the economy. We had I believe, very positive earnings season, which is not quite over, but we've had some very positive signals. But the near term, this fog that's on the road right now, I think is having us pause and maybe saying, maybe we should, sort of watch things for a little bit. So near term, I would say we're still bullish, but I think we have to be very careful here because there's just, there's a lot of tension. Underlying the market. We're just underneath, all-time highs. There are a lot of, clearly overpriced things, which can still go up, but you're not going to take that shot if you feel like some craziness is going to happen in the next couple of months. I think things are not going to calm down until at least next quarter. I think then we'll hopefully have a better view of what the sort of mid to long term is going to be like.
Mark, what do you make of the move we've seen in the bond market? I'm looking at the 10-year, the benchmark. We're back down to 4.3, Mark. What do you make of that? What explains that move? Where do you see that headed from here?
Yeah, I mean, listen, it's good that the 10-year yields are coming down. I think that helps certain sectors for sure. I think that could be a positive for the market. I know that the administration would like to see the yields lower, and for good reason, because it would be very stimulative to the economy, especially in real estate. But this is maybe not necessarily the way we want to get it there, right? The yields are coming down because of increasing fears of what's going to happen with the economy. Now, again, a positive, but caused by what I think is a negative.
Mark, always great to see you and to see you on set. Thank you for joining us.
Great to be here. Thanks so much.
Turning now to shares of Dell Technologies as its fourth quarter results just now hitting the wire. Let's get to those numbers. Q4 adjusted EPS 268. The street was at 253, so that is a beat. I'm looking at Q4 total revenue. That clocks in at $23.93 billion. The street was actually closer to $24.65 billion. In terms of what they see ahead, they see Q1 revenue, Julie, they're calling for between 22.5 to 23.5 billion. The street was at 23.55 billion. And for the year, it looks like they're calling for 2026 revenue between 101 to 105 billion. Analysts on the street, it looks like had penciled in about 103 billion. Some capital return news as well. It looks like the board does okay a $10 billion increase in that share buyback authorization.
Whew, and investors don't know what to do with this, right? Initially, we had the stock going down pretty sharply. Now it is taking a leg up, maybe on that cash return as investors are reading through and got to that headline. Kind of unclear what has been going on there. And this stock, it did relatively well for most of last year, and then kind of slid a little bit, but it's still up 18% over the last year. And the company in the release talking about last year being, or its fiscal 25 being a transformative year here. Dell sort of getting caught up in the AI trade as well in terms of providing servers for some of those data centers. Maybe again, it is that dividend going up by 18% that is helping cushion the blow of what looks like to be a revenue forecast that is a little bit short.
Yeah, I do see a headline here that the COO does say the AI server backlog at the company, roughly $9 billion as of today. And of course, a lot of folks have thought of Dell as a new way to play that AI trade. It'll be more interesting to see what other commentary you get on that AI business, the AI server business. Shipments, backlog, margins, What are they seeing? It was interesting because we had some analysts and we talked about this heading into this print. They were a little bit more nervous about this AI server business because they were talking about supply chain constraints. It'll be interesting what the execs have to say on the call about that.
Yeah, unclear if that $9 billion is a new number. It's Jeff Clark, who's the CEO, who's making those comments in the release. He said the deals we've booked with XAI and others put our AI server backlog at that $9 billion. So we'll dig into that and see what the analyst reaction is.
Yeah, you want more color on the PC market too. That's always front and center here. Consumer sales, corporate sales. Also, I'm just very curious what they have to say about the competitive landscape.
Yes.
We know what a rough year it has been for rival server maker Supermicro.
Yes, definitely.
All right, coming up, we're going to get you the latest earnings results from HP Inc. As those results are just crossing the wire as well. Stick around. Much more market domination over time coming up.
Snowflake saw shares pop today as it projected better than expected revenue growth. That company also expanding its AI footprint with the new Silicon Valley AI hub and a $200 million investment in next-gen startups. On the flip side of that software space, we've got Salesforce providing fiscal year revenue guidance below Wall Street's expectations. That company expecting its new AI product Agentforce to make a modest contribution to revenue this year. Those shares fell 4%. So here to sort through software's uneven AI boost, let's get to Wolfe Research Managing Director and Head of Software Research, IXIC, who happens to be happily for us in town today and in our studio. Thanks for being here.
Thanks for having me.
So I guess, first of all, just big picture, how should we be thinking about the software landscape right now and the AI effect? Because it does feel sort of lumpy, for lack of a better word.
I think when you think about software right now, there's a lot of uncertainty in the air. I think for investors and quite frankly for customers, how is AI going to be monetized? How is it going to add value? How is it going to translate into incremental dollars? How does each company differentiate their AI solution? You hear everybody talking about agents, but it's unclear what the difference is between one agent versus the other. I'm a perpetual optimist. I think this is the best time to cover software because I think that a lot of these innovations are going to expand the markets, the addressable opportunities. I think there's going to be a lot of jobs that are changed foundationally and fundamentally, but ultimately there's going to be more digitization of labor, of workflows, of data that lead to better outcomes. And I think that the real value for these companies is that they understand the businesses of their customers. They have the data model, and they can put AI in context to unlock that value in a secure, cohesive way that doesn't introduce new business risk.
Let's talk about some specific names, Alex, in your coverage universe. Salesforce reported they offered, I saw what's being described as a tepid outlook. But I'm just curious to get your take on that report and why you're telling clients this one's still a buy.
Yeah, I am. Look, I think right now, given all of the headlines around the macroeconomic environment, around the geopolitical environment, even for Salesforce, which just went through some management transition where they have a new, what they're calling COFO, COO/CFO, I think it's prudent to embed conservatism. It's a little bit of an uncertain world. And I think that when companies enter into a Q1 after usually what I would describe as a little bit of a hyper-seasonal Q4 period, it's good to inject that conservatism. Investors want a beat and raise story, and I think that's what Salesforce is positioning themselves to be for the duration of 2025 with this conservative outlook.
I guess the question is, if we are in a more uncertain macro environment, even potentially a slowing macro environment, presumably companies are going to want to save money. And I guess then the question becomes for these enterprise software companies, can they make that value proposition sale to these companies? Can they go to them and say, we can make you more efficient, we can save you money, even if you're spending money with us? Can a company like Salesforce successfully make that argument right now?
I think they can. I think they've spent the last, call it really 2 to 3 years getting fit. I think a lot of the companies in the enterprise software space went through really their first cycle where they had to go, where customers looked at their software spend and they looked at what was being used and what wasn't being used, and they started to rationalize. You've seen companies invent new words like platformization, and that's a term that basically means let me look at what I'm using, what I'm not using. I had everybody have a license for everything. Now I need to really take a really hard glance at what am I getting value out of. We're on the other side of that, and I think now, for some companies that can provide both breadth, depth, and a strategic outcome for their customers, there's an opportunity to do more with them. And there's an opportunity for them to offer more value-added services in the form of agents, in the form of AI, in the form of these data products that can unlock that value.
I was talking to another financial analyst covers some of these same names, colleague of yours on the street. And we were funny because when I asked him about AI agents, he said to me, my eyes glaze over when I heard AI agents, which was interesting. And I'm just curious, as a financial analyst, how do you try to distinguish, okay, you hear AI agent, what's between what is real and what is marketing fluff at this point?
I think we're in a world where you have to try things, and it's hard to price and effectively promise certain or make commitments on certain amounts of revenue when we're in that trial phase. I think that this technology is moving extraordinarily quickly, and I think this year is the year that a lot of these companies start to actually show value. So remember, Salesforce, when they guided for the year, and they were asked many times about Agentforce, they said it would be a modest contribution. Now, I asked about the definition of modesty. And it's beauty's in the eye of the beholder, but I would argue this year is the year that you start to see companies really put this stuff into production and unlock some value. And what that means is probably a point, maybe a little bit more than a point, maybe a little bit less than a point of incremental value, incremental bookings for these companies that are charging for it. And you're seeing some companies kind of maybe offer some of this functionality for free, get it in the hands of their constituents before they really try to turn on the monetization engine, which is another very logical outcome. People don't want to get into a situation where they're overpricing and under-delivering. There are some companies that, you would argue are suffering a little bit from that first mover advantage in the enterprise space. So I think it's prudent to be a little bit careful at this point in time.
I mean, investors are being careful. They're not yet buying in. I mean, you look at Snowflake, for example, which, yes, rose on its earnings, but the stock is down like 25% over the past year. So if your thesis is correct, I guess the next question is like, when are the investors going to come? Are they waiting for this initial discount period of the product to then get in?
I think for a company like Snowflake, you look at the consumption names and you've effectively been dealing with this. Are they an AI winner? Are they an AI loser? Does AI even matter? And I think, look, at the end of the day, it's a question about growth rates. There's not that many companies at all, but in the enterprise software space, that have the capability to grow high 20s or 30%. That's really the opportunity that we see with Snowflake, which is why we recommend it to our clients here. We think that if they can show that the spend intensity on what they're selling is improved, because companies went through a little bit of a fog of war where they didn't know how to spend on the right platforms given all the changes that were coming with AI. Now they do. And now they're resuming their spend. They're looking at unlocking incremental value of their data within the confines of the enterprise estate. One of the most important announcements Snowflake made was the announcement with Microsoft, where you can now manipulate OpenAI models directly inside of your Snowflake instance at the same time as you can also use models from Anthropic. Not a lot of companies have the opportunity to offer that service at the same time. And so we think that you're looking at probably the second half of this year when some of this re-acceleration really happens. Q1's always a tough quarter for enterprise software. It's usually, even when there aren't as many geopolitical and headlines about the macro, a period of just figuring it out. So I would anticipate it's the second half. You saw this same movie last year, where software ripped at the end of the year, and then it underperformed through May or June, and then it ripped again. And I would anticipate a similar seasonality from an investor participation perspective. They want to make sure that we're not in a head fake, and that Q4 and the improvements that we saw in the second half of last year were not one time only. I think they want to see that durability. And so as you get Q1 reports, as you get more CEOs better understanding the environment that we're in, I think we're going to see a better landscape.
Alex, really helpful stuff. Thank you so much.
Thank you, guys.
Good to see you in person. We got to get to some more earnings here. HP Inc. crossing the wire moments ago. The share's not moving much, even as revenue beat expectations. It looks like the second quarter forecast is short of estimates. So let me run through it here. Net revenue in the quarter at $13.5 billion here. That was up just 2.4%. It looks like from the prior year. The company says earnings per share in the first quarter coming in at 74 cents. That is bang in line with analyst estimates. For the second quarter, adjusted earnings per share are going to be 75 to 85 cents. Analysts had been looking for the upper end of that, so that perhaps a little bit disappointing here. And the company, I guess that is that forecast here for the full year, is unchanged as well. So, maybe investors not very excited about this report.
Yeah, I see CEO Enrique Lores out with a statement, talks about pleased with the Q1 performance. achieving revenue growth for the first straight quarter, he says, advancing our strategy to lead the future of work. Talks about strong commercial business and personal systems, momentum in growth areas, including, he calls out AI PCs. It'll be, listen, always interesting to get his take on just the PC market. What's the trajectory look like to Enrique Lore's consumer, commercial pricing, and of course,
tariffs.
Printing, ink and toner, always critical for this company, right?
Sorry for my tariffs interjection.
Yes,
I'm just yelling tariffs randomly throughout the day because it's on everyone's
You'll probably be
mind.
right. That's the thing.
Tariffs. But yes, tariffs is something that is going to be relevant for HP as well. So that's also something that potentially, even if it didn't weigh yet, it's something definitely that the company is going to have to be keeping an eye on. So that's all going to be part of the discussion with Enrique Lores, because you can head over to the Yahoo Finance website later today. Our own Brian Sozzi is going to be talking to the HP CEO, Enrique Lores, at 6 p.m. Eastern. Keep an eye out for that.
Time now for what to watch Friday, February 28th. We're going to start off on the economy, a key piece of economic data coming out in the morning with PCE, that's personal consumption expenditures. Economists forecasting that the Fed's preferred inflation gauge for January will hold steady for total PCE at 0.3%, and core PCE will tick up slightly to 0.3%.
Moving over to the Fed, we'll be getting more Fed commentary from Presidents Tom Barkin and Austin Goolsbee throughout the day. And it comes after comments from Atlanta Fed President Raphael Bostic yesterday. Bostic saying that interest rates need to stay in restrictive territory and continue putting downward pressure on inflation.
And taking a look at earnings, no rest for the weary this season. Some more reporting coming out from Fubo and TeraWulf in the morning. Fubo announcing results for the fourth quarter before the opening bell. Analysts expecting a 9% increase in revenue year over year. And we'll listen closely for any commentary on the company's potential deal with Disney.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Ashley for a Trend. We've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. Stocks closing lower yet again Thursday. It's after President Trump reiterated his plans for tariffs against Mexico and Canada to go into effect March 4th, plus a new additional 10% tariff against China. We're going to dive into the rest of today's market trends. Then, after a drop of almost 8% today, investors are telling Nvidia its earnings were good, but not good enough. We're going to take a look at what the chip giant's future looks like. Plus, investors are pulling out a record amount from Bitcoin ETFs amid increased price volatility. We're going to bring you the very latest in all things crypto. Nvidia delivered another solid quarter of results Wednesday, but investors are making it clear the results not good enough. The stock down nearly 8% in today's trade. And joining me now is Ross Gerber, Kawasaki Wealth Investment Management CEO, and Yahoo Finance's very own Julie Hyman. Welcome to you both. Ross, let's talk about NVIDIA, because it was interesting, Ross. Today you kind of combing through the analyst reports, the analysts who are paid to give you a recommendation on what to do with NVIDIA. I would say, Ross, they were broadly positive. Analysts were saying, listen, the reports were solid, demand is strong, the guidance was fine, but investors, took this one down about 8% in today's trade. I'm curious, Ross, what you made of the report and the reaction.
Well, the report was exactly what we had expected, and great numbers by any stretch of anybody's imagination. So really what it comes down to is the market itself is going through sort of a revaluation process because of the Trump administration policies that create a lot of uncertainty with trade. And NVIDIA has kind of caught up a little bit in that in several areas with China and then the manufacturing of chips outside the United States. But really, NVIDIA is kind of a great value if you want to invest in AI and you look at what their earnings estimates are for the next 4 quarters, and then you're looking at a PE now of, 25 forward PE, so maybe 30. So this is a great opportunity for investors who see the long term.
Well, and Ross, it's Julie here. It's good to see you. I think one of the questions around NVIDIA was not whether it could keep on delivering, but it's like, do you see a sort of a law of diminishing returns where it's so large and it's still growing by enormous double digits, right? Which for any company its size would be unusual. But even your point taken about what the PE is, but at what point then does it sort of get priced into the stock and all of these expectations for that growth?
Well, besides its incredible numbers that, are pretty, unique in corporate American business history in their growth over the last several years, but if you really just look at a chart of revenue growth or earnings growth, this thing is just a monster and it continues to go. But, as companies get bigger, their PE ratios, in theory, should compress a little bit as they get harder to grow. Now, it wasn't that long ago people were saying the same thing. Oh, a company is not going to be $1 trillion once it gets to be $1 trillion. How could it get bigger? And now it's $3 trillion. How could it get bigger? Well, how do you make $22 billion in 3 months? That's incredible. And so it's really about how they deploy their capital that's important. Management is really focused. They're delivering, and we're just at the beginning of the AI revolution. So I think for us, we're long-term investors in NVIDIA. I've owned it for a decade. We're not selling it. I would look for every opportunity to buy this stock. We're already overweighted, so, and it's our largest position at my firm. But, if you're an investor and you believe in this stuff, you look for these opportunities. Now, I do think the correction has some more room to go just in the markets themselves. So, I'm cautious in adding technology at the moment, but it's mostly just because I think the market has begun a correction.
Is there a level you'd be watching, Ross, on NVIDIA where you'd be like, okay, that is the opportunity I'm waiting for to move in?
Well, it's kind of there now. I like this level right here. As I said, I don't have a lot of confidence in the markets working higher right now because of the policies that are being thrown at the world by the Trump administration. And so when you have such regressive economic policies being batted around, you sort of have to ask, do I want to add risk here? And that's what we're seeing in Bitcoin, and we're seeing it in Nvidia and all the high beta names is people are risk off. And And a lot of money's rotated into Europe and China, and that's what we've been doing at our firm, adding gold, diversifying more, getting more conservative, because if you look at the market multiple and what's happening, as I said, I think the market could work itself, 5 to 10% lower from here, and that would be healthy, and that would be a time when I would be a buyer.
Ross, we have to talk about Tesla since you're here. I feel like we're obligated. I feel like we've talked to you in the past that you have Teslas, right? Maybe you were going to buy a different car. Are you one of the people putting the bumper sticker on the back of your Tesla that says, I bought this before, blah, blah, blah?
No, and the people who say I bought this before Elon went crazy, Elon was always crazy. So that is kind of a weird bumper sticker. I think for me, it's reconciling the fact that I care about climate. I think they make great EVs. I want people to buy, whether it be Teslas or any EVs. I drive a Cybertruck right now, and the part that's painful is just people hate Elon so much that you just feel the unhappiness that on the vehicles, and a lot of people are sort of just driving them in shame because we care more about the environment than trying to pretend
Ross, pardon me, but you got a lot of choices from EVs right now. You don't have nobody's making you buy a Cybertruck.
That's right. And the truth is that Tesla still makes the best EVs by a wide margin. So, you're right. And I would get rid of the Cybertruck and maybe buy something else. But I bought the Rivian too. I have a Rivian and I love the Rivian as well. So I wasn't really going to buy another Rivian. But, right now in my life, actually, this is the first interview from my house that I've been able to do since the Palisades fire. So I'm very, very happy. And the Cybertruck was just like an incredible vehicle to have during, the apocalypse that I just went through for the last 2 months. So, I'm a little bit grateful to the Cybertruck, to be honest.
Why, Ross? Why do you say that?
Because the vehicle works incredibly well for what it's supposed to do. And, for an electric truck, and the way, not only the speed, but the reliability and the strength of it. I've had to drive through mud. I've had to drive over trees. I've had to drive through fires, floods. I mean, I'm in like the third level of the apocalypse right now. As I said, this is the first day I've been able to even be at my house. I'm hoping to move back, this weekend after 2 months of living in a hotel. So when crap goes down, Tesla products work. The Starlink is a lifesaver. I'm putting power walls in my house as soon as possible. So it's almost like Tesla was built for, climate change. And that's why I love Tesla. I think Tesla's a great company. I think it needs new leadership.
First of all, we're glad you're okay, Ross, by the way, and we're glad you're back in your house. I know it's been a tough time out there in LA. What about as a shareholder, though? So you're talking as a customer, obviously, and you're also talking as a shareholder, as someone who wants to see that leadership change at Tesla. We haven't really had the chance to catch up since this whole Doge thing has heated up. And there's really has been this wave of sentiment against Elon Musk that seems to be hurting the sales of the company as well. What do you think happens next? What should happen next?
Well, one thing I'm sure of is that politics and selling products just doesn't mix, and so, the dislike to Elon's approach to, everybody thinks the government should slim down, but the approach is really the problem. And it's really affecting a lot of people, and it's creating a lot of animosity towards Elon, and therefore people sort of extrapolate that out onto Tesla. And it's, once again, it's super unfortunate that such a wonderful company with a great brand, which I've been saying for now years, was on the verge of being severely damaged if this path was continuing to go. And now that's happening, and now we're seeing it in sales. And I think this quarter is going to be not a good quarter for Tesla. And fortunately, they're launching a new Model Y, which might help them next quarter. But the truth is, people identify with their vehicles, and people don't want to identify with Elon Musk. And unfortunately, they take that on Tesla. And, it's unfortunate. So we've taken the opportunity with higher stock prices to continue to lower our position in Tesla. We still own a lot of Tesla. So, I can't say being down 30% on Tesla, I'm happy about, that hurts our shareholders. And, in my fund, we lowered the allocation, a lot to almost nothing. But in real life, we still own, probably around 250,000 shares of Tesla. So it's been a tough year for Tesla shareholders, and I don't see it getting better because it's still trading at over 100 times earnings.
Ross, always good to see you, and thank you so much for joining us today on the show. Appreciate it.
Yeah, thanks for having me.
Stick around, much more asking for a trend still to come. Crypto remains under pressure as Bitcoin continues to pull back from a post-election. The cryptocurrency falling below 84,000 to hover near their lowest point since November. Yahoo Finance's Jared Blickreed joins us now with more. Jared.
It has not been pretty in crypto recently, although if you're looking at the chart here, Bitcoin is up 11 basis points over the trailing 24 hours. That only means the damage has been done before the prior 24 hours. This is a 5-year chart. Let's reduce this to a 5-day because that's about the length of the slide that crypto has been put under here. And you can see Bitcoin's down to 13% in that time period, roughly a 3-month low for Bitcoin. And I was looking at a volume profile chart, and this is an indicator that we have in our chart system, so you can get that on your mobile app or desktop. And let me just set this up. This chart goes back to the beginning of 2024, and you're going to see this little histogram here. Might be hard to see on our charts, but you can see it on the site a bit better. And this just shows you how much volume has been transacted at various prices. And you can see the longer price has hung out at a level, the more volume, as you would expect, transacts there. And so it's a good way to visualize when price is in free fall, as it was yesterday, where it might eventually stop. Now, currently it stopped at 81,000. I didn't have that as a major level. It's a trend support, so that's a different system. But I think ultimately it's probably going to come down and test this lower price memory here that starts at about 70,000. So this is 70,000 all the way down to about 45 or so. Don't quote me on that. But that includes this entire area that we traded in for most of 2024 before that big election breakout. So to put it in context, we're in the midst of a pretty big breakdown right now, but it could get a little bit worse before it gets better. It's just the odds talking here. Now, I want to get back to crypto here, and you can see Bitcoin just flipped negative. We have some incremental news on the crypto front in a few different areas. There is a civil suit that the SEC had going against Coinbase. That was just dropped. We just got that headline crossing the wires, and we also got some incremental news on meme coins and their treatment. I don't have the full details, but that's something we're going to be looking into tomorrow. Let me just check out Coinbase stock real quickly after hours. It was down 2% today. Let's see where it falls in the after hours. I think it was up about 1%. And there you can see it. It's up 97 basis points, almost 1%. So Coinbase benefiting from that news just a little bit. But if we can go back to crypto one more time, I'm going to show you the year-to-date price action in everything here. And it's just looking pretty negative. You can see Bitcoin down 10%, Ethereum down 30%, Dogecoin down 36%, and the board, if I sort by performance here, looks pretty negative. Only a couple of positive surprises there. Litecoin and what is that, Monero? So I haven't talked about that in a while, but for the most part, crypto under a bit of pressure here. Back to you guys.
Thank you, Jared. The Securities and Exchange Commission officially dismissing the civil enforcement action against Coinbase. Joining us now to talk more about all things crypto is James Lavish, co-managing partner of Bitcoin Opportunity Fund. James, it's interesting off that headline. Listen, you think about the Trump administration. Trump clearly campaigned as an ally of crypto. It's not just Trump, by the way. We always remind people, I mean, you look at his team, it's J.D. Vance and Howard Lutnick, RFK Jr., they're all fans. And the big move, of course, we saw after the re-election, the election win, was the crypto community saying, okay, we've got a new friend in the White House.
Yeah, we have an administration that is actually embracing crypto and Bitcoin in particular. And so it's not a surprise that this has been dismissed. We've got new SEC chair, we've got a new Treasury secretary, we've got, like you said, a crypto-friendly administration now, which is exactly opposed to what we had in the last administration, which was pretty antagonistic. So, Bitcoin had a solid run-up right after the election, and that was not surprising. We expected that, and now it's just taking a breather as we have risk off with the entire market right now.
When you say breather, what do you chalk up that breather to, James?
Well, there's a couple things, right? So we, first of all, you have just a risk-off environment in the markets generally. All the markets have kind of gotten ahead of themselves. Again, a lot of euphoria around this administration and deregulation and probably a little bit of liquidity that they expect to come into the market. So it kind of got ahead of itself. And so Bitcoin and crypto, Bitcoin in particular, has been the head of the tip of the risk spear for years now. And so when you see risk off, well, Bitcoin is going to kind of exaggerate that. And then all the other coins around it will be a high beta to that, so they'll have even more risk off. And so that breather is coming in and filling in that great run-up that was on pretty good volume, but there was no support there. And so you can see it retracing back to that 70, 75 level. Does it get there? Remains to be seen.
I know you saw that Bloomberg had a good stat. Make sure I got this right. Saying investors yanked more than $1 billion from spot Bitcoin ETFs on Tuesday, James, marking the biggest one-day outflow since the cohort's debut last January. Does that surprise you, that level of outflow?
Well, there's a couple things. So first of all, you had the Bybit debacle, right? And so
the hack.
Yeah, the hack. And so it's $1.4 billion got stolen. It was sophisticated, a social engineering hack, but so that kind of scared people, and it scared them out of the whole industry, and not surprising. So that's one thing. The second thing is you do have this, there's something called like a basis trade that you have hedge funds are buying the ETFs long and they're shorting futures against it, or some sort of mix of that, and they're trading around that arbitrage of that. And so you could see them unwind that trade, and that might be part of it as well. So it doesn't really surprise me that much, but it's just a new structure. It used to be you had to buy Bitcoin and go through exchanges like Coinbase or Kraken or whatever, but now you can buy them on the New York Stock Exchange. So you've got these big institutions that are playing in there that it's just different. So you have money moving out that you didn't have before.
You mentioned the hedge funds. In terms of those outflows from the ETFs, I saw some speculation that maybe it was also a lot of folks who are new to this space, James, and maybe they're kind of not quite used yet to the headlines and how volatile this can be.
Yeah, sure. So you have a lot of new players with the ETFs, and you probably have a lot of OGs, the original holders of Bitcoin that have held it from just $1,000 or a few $1,000s and have run all the way up to $100,000, and they're filing out as well. So it's a little bit of everything, I think, but it's not surprising with risk off across the board. This is to be expected.
So what's the catalyst that gets Bitcoin moving higher again? I mean, are there specific key kind of regulatory changes you're waiting for, James? Could that be it?
No, I think that you do have a lot of headwinds. You've got a number of tailwinds that have kind of accumulated over the last year and a half between the new GAAP accounting rules, S&P 121 being overturned. You've got the ETFs and the ETF options. You've got the new administration. You've got the possibility of a Bitcoin reserve, strategic reserve. So all of those are tailwinds, and those will happen those will incrementally just give Bitcoin that lift or that support over time. But is there any one thing that I'm looking for? No, I think that what I'd like to see is just a capitulation and get this, get this worry and this risk-off trade out of the way, and then that will be that time to, that's the time to step in. Once you have everybody feeling that sentiment being perfectly negative, that's the time to step in. We're getting close, I think.
James, great to see you, and great to see you on set. Appreciate it.
Yeah, I appreciate having me.
Coming up, live tariff talk on earnings calls this season. We're going to break it down in our chart of the day. More Asking for a Trend right on the other side. For our chart of the day, we're looking at tariffs mentions from earnings calls. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Yeah, so basically, Bloomberg crunched the numbers, looked at how many times companies talked about tariffs on their calls. Either, basically, this is the word tariffs in conference calls, how many times they were said either by executives or by analysts asking questions here. And they've tracked them for a while here. Obviously, it wasn't really a subject of discussion for a long time until President Trump's first term in office, when we saw the prior peak in this kind of discussion. A lot of concerns about what effect they would have. Then the mentions went back down, even though It's worth mentioning that President Biden kept in place some of President Trump's tariffs on China in particular. But now, obviously, we are seeing another peak, 700 mentions over the course of earnings season. That is a record here, even higher than the prior peak. And as we've been talking about really all day long, it reflects all of this uncertainty that everyone, from investors to consumers to companies, are feeling. We talked to Mark Malik of Siebert about that a little bit earlier in the show.
That's the job of management to anticipate these types of things. I think the challenge is again, if we knew what they were, if the companies knew what they were, because now we're talking about a VAT tax and a VAT tax versus a tariff, and I think, you know, at the end of the day, it's all kind of negative.
But we don't know exactly how negative is part of the issue, Josh. If these companies had the certainty of the tariffs being imposed, but there is sort of this back and forth, there is the uncertainty about whether President Trump will go through with his threats to impose tariffs on Mexico and Canada, for example, or if there will be once again an 11th hour agreement, or even if there's not, will there then be a month later? Will the tariffs last a month? Will they last a year? Will they last indefinitely? Companies don't know this, and so it's very difficult to make plans. Josh?
All right, thank you, Julie. Now let's take a look at what's trending after hours here, starting with SoundHound AI. That stock jumping double digits after reporting Q4 earnings, delivering a beat on revenue and raising its full-year revenue outlook. Make sure to tune in to Ask You for a Trend tomorrow at 4:30. We're going to have the SoundHound AI's co-founder and CEO on the program. Autodesk shares rising as it tops fourth quarter earnings expectations. Company also providing a better than expected profit outlook for the full year and first quarter. Autodesk noting it's beginning the optimization of its go-to-market functions to better meet evolving needs of its customers. Duolingo topping fourth quarter revenue estimates, total bookings growing 42% year over year. Looking ahead, the company expects to see full year revenue of $962.5 to $978.5 million compared to an estimate of $965 million. For more on the results, be sure to catch Yahoo Finance's conversation with Duolingo CEO on the morning brief. That's in the 9 a.m. hour. That's a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.